This video is about IRAs. IRA or IRA is short for Individual Retirement Account, and it is a type of plan for retirement that became available in 1975. There are several different types of IRAs, but the most popular is the Traditional IRA. A Traditional IRA works something like this. Contributions are made to the plan with pre-tax dollars. Depending on your income, these contributions are usually tax deductible. In 2020, if your modified adjusted gross income is over $65,000, your deduction may be phased out, depending on different factors like tax filing status and income. These factors can change from year to year. Modified adjusted gross income includes any earned tips, commissions, bonuses, taxable fringe benefits, or business income if you run your own business. It does not include income from securities, rental property, assets, alimony, child support, Social Security, unemployment benefits, and wages earned by penal institution inmates. There are no limitations on how long you can make contributions to a Traditional IRA or what age you must be to open an account, but there are limitations on how much you can contribute. In 2020, these limits are $6,000 per year if you're 49 years old and younger, or $7,000 per year if you're 50 years old and older. Like many other retirement plans, there's a special tax break given to low and moderate income level taxpayers contributing to IRAs. This tax break is called the Saver's Credit. If you are 18 years old or older, not a full-time student, not filed as a dependent on someone else's tax return, and you meet the income requirements, you are eligible for a Saver's Credit, which can reduce your tax bill. It is good to note, however, any excess contributions and rollovers do not count towards the Saver's Credit. Growth in a Traditional IRA is tax deferred, so you won't be taxed on the contributions or the growth in your account every single year. Instead, you'll pay the taxes later when you take money out of the plan. To take money out of your IRA, you'll need to wait until age 59 and a half, otherwise a 10% penalty will be charged on the money you withdraw. After 59 and a half, you can make withdrawals with no penalty. You'll just have to pay taxes on the money you withdraw. Once you reach age 70 and a half, the IRS allows you to make qualified charitable distributions of up to $100,000 per year tax-free to charities. This could be a good idea if you have to make a required minimum distribution but don't want to pay taxes on the extra income and you want to give the money away. By the time you are 72 years old, you must take at least the required minimum distribution from your IRA. In regard to inheriting or leaving an IRA to someone, the beneficiary is required to take all the money out of the IRA within 10 years. This is a big favor to the IRS because taking distributions can actually bump the beneficiary into a new tax bracket where they'll have to pay more taxes. If the beneficiary is a minor child, this 10-year rule does not apply until they reach adulthood. The two exceptions to this rule are, number one, if you inherited an IRA before 2020, and number two, if the IRA has been left to an eligible designated beneficiary such as the surviving spouse, someone who is no more than 10 years younger, or a chronically ill individual as defined by the IRS. Here are some other good things to know about IRAs. You can't take a loan from them. Most IRAs can't be used as collateral. Another popular type of IRA is the Roth IRA. Roth IRAs are similar to the Traditional IRAs with a few differences. For starters, the Roth IRA is funded with after-tax dollars. This means there is no tax deduction. However, the growth in a Roth IRA is tax-free, and so are withdrawals, as long as all the IRS guidelines pertaining to the Roth IRA are followed. Not everyone can contribute to a Roth IRA. Only people with eligible income below $139,000 for single filers or $206,000 for married couples filing jointly can qualify for contributions to a Roth IRA in 2020. Contribution limits to a Roth IRA are similar to a Traditional IRA but are phased out over different income levels. These limits can also change from year to year. Like the Traditional IRA, a 10% penalty will be charged if you withdraw any earnings from the plan before age 59 and a half. But contributions can be withdrawn from a Roth IRA penalty-free after 5 years. Unlike the Traditional IRA, the Roth IRA does not have any required minimum distributions. Then there's the Rollover IRA. A rollover IRA is created when another type of retirement plan like a 401k, 403b, or even another IRA is rolled into a new IRA. Rollover IRAs most commonly occur when people change jobs and want the money from their 401ks or 403bs to be put into an IRA. A rollover IRA can be created two different ways. Number one, via a direct rollover, or number two, an indirect rollover. A direct rollover is just what it sounds like. The funds from the old plan are directly rolled over into the new plan. An indirect rollover is where a check is written for the amount inside the old retirement plan. The check must be used to fund a new IRA within 60 days or the money will be taxed as income. And if you're under age 59 and a half, you'll also have to pay a 10% penalty. With an indirect rollover, the custodian, which is the financial institution holding your IRA account, withholds 20% of the money from the old plan. This 20% will be paid to the IRS next tax season and will be credited to you, the IRA owner, as taxes already paid. However, if you are in a higher tax bracket, say 37%, you will owe taxes on 37% of the funds withdrawn from the IRA, not just 20%. This tax withholding can be avoided by doing a direct rollover, which places your assets directly into the new IRA without drafting a check and without paying the tax until you withdraw money from the new account. It is good to note if you roll a tax-deferred IRA, like the traditional IRA, into a Roth IRA, you will owe taxes on all the money from the old plan, even if it is a direct rollover. This is because the traditional IRA is funded with pre-tax dollars and the Roth IRA with after-tax dollars. Whenever you roll from a pre-tax plan to an after-tax plan, you always have to pay tax. Another kind of IRA is the SEP, Simplified Employee Pension IRA. SEP IRAs are supposed to benefit employees and self-employed individuals. They're heavily favored by employers because of their low setup costs and lower management costs compared to other retirement plans. Employers can choose the amount of contributions made into a SEP every year, as well as make tax-deductible contributions to the plan on behalf of eligible employees. However, the employer cannot contribute more than 25% of an employee's total compensation into the plan, or more than $57,000 for 2020, whichever amount is less. Employees must earn at least $600 in compensation every year in order to participate in a SEP. SEPs aren't just for employees. People who are self-employed can start a SEP even if they have a retirement account with another employer. To participate in a SEP, you must, number 1, be at least 21 years old, and number 2, have worked for your employer 3 out of the last 5 years. Number 3, you must have received at least $600 in compensation for the year. Like traditional and Roth IRAs, SEP IRAs will trigger a 10% penalty if a non-qualified distribution is taken before age 59 and a half. For small businesses with 100 employees or less, there is a Simple IRA, which stands for Savings Incentive Match Plan for Employees. Simples are tax-deferred like the traditional IRA and allow employers to contribute 2% of the employee's compensation each year or match up to 3% of what the employee contributes. Employers may require employees to earn at least $5,000 each year for the last 2 years before they are eligible for a simple plan. Employees are limited to a maximum contribution of $13,500 each year unless they are 50 or older, and then they can contribute up to $16,500 each year. If you withdraw contributions before age 59 and a half, the penalty is at least 10%, but can be as high as 25% if the contributions were not in the plan for at least 2 years. Some downsides of the Simple are, number 1, there's no retirement plan may be rolled into a Simple plan. And number 2, Simples cannot be rolled into a traditional IRA without a 2-year waiting period from the time the employee first joined the plan. Number 3, the business owner cannot save as much in a Simple as they could in a SEP or a 401k. Another kind of IRA is the Spousal IRA. Spousal IRAs are just regular traditional or Roth IRAs, which allow a working spouse to contribute money into a retirement plan in the name of a non-working spouse. The non-working spouse can also make contributions to the plan. However, the working spouse's income must be equal or greater than the total contributions made into the plan. The last kind of IRA is the Education IRA, known as an ESA, a Coverdell Education Savings Account, or Coverdell account. The ESA is not a retirement account at all, but rather a schooling expense account to be used for education-related expenses at any educational level. These plans allow parents, children, individuals, corporations, partnerships, and other entities to contribute money into a plan for education expenses on children under age 18. To contribute to an ESA as a living person, your modified adjusted gross income must be under $110,000 filing single or $220,000 filing jointly. Contributions must be made with cash and are considered gifts for tax purposes. No tax deduction is given. Unlike the traditional and Roth IRA, contributions do not have to be funded with earned income. A maximum of $2,000 can be contributed to an ESA each year, and it is considered a gift for tax purposes. If more than $2,000 per year is contributed on one minor's life, a 6% penalty will be charged on the extra contribution. This penalty can be avoided by removing the excess contribution along with any growth on that contribution before the reporting deadline of May 31st, which applies to the previous tax year. Money in the plan can be invested in stocks, bonds, mutual funds, and certificates of deposits, which can grow and compound tax-free. However, funds in an ESA may not be used to buy life insurance. In fact, you can't buy life insurance within any IRA account. Instead, you would need to take a withdrawal, pay taxes, and any applicable penalty first. Funds withdrawn from an ESA are tax-free as long as they're used for qualified expenses like tuition, books, and uniforms for schooling. If the funds are used for expenses not allowed within the ESA rules, a 10% penalty will be charged as well as income tax on any growth. Once the beneficiary of an ESA plan turns 30 years of age, all money must be fully withdrawn within 30 days, or the beneficiary can transfer the account to a new beneficiary such as a child under the age of 30. If the original beneficiary chooses to withdraw the remaining funds at age 30 for non-education purposes, they will pay a 10% penalty and taxes on any growth. Throughout this video, we've mentioned the 10% penalty for accessing money from an IRA before age 59.5. The Coronavirus Aid, Relief, and Economic Security Act, also known as the CARES Act, was passed on March 27th of this year. This act waives the 10% early access penalty, so anyone accessing money from an IRA before age 59.5 under the CARES Act will only have to pay taxes and not the 10% penalty. Many people are losing money because of typical financial planning. At Life Benefits, we have a formula that helps people keep more of the money they make so they can have financial peace of mind. Part of this formula consists of participating in whole life insurance to provide a guarantee, minimize taxes, and eliminate penalties. For more details about this type of life insurance, please watch the video Whole Life Insurance Explained. The link is in the description box below. If this video was helpful to you, please give it a thumbs up. Also remember to subscribe and ring the bell to receive notifications when new content is released on the channel.